DCSL Corporate Services is a multi-service firm, and some of our services, as you would see on my screen, governance services, which entails board reviews and peer reviews. We train directors and senior management. We also provide business advisory and regulatory compliance services. We provide company secretarial support, executive talent recruitment, director selection, surveys, and research. UTL Trust Management Services, formerly known as Union Trustees, is a foremost corporate trustee that has over the last 5 decades provided innovative trust solutions to its diversified clientele. The services provided by UTL include trust services, bonds, estate planning and administration, as well as fund management and portfolio management. UTL recently deployed her triple award-winning online will writing service known as Willpower, which can be accessed on that website, www.willpower.ng. I will see a little bit about Willpower later on in the course of the conversation. I'll now quickly like to introduce our panelists for this evening. Mrs. Olufunke Ayekola. Like I mentioned earlier, she's the MDCE of UTL Trust Management Services. Funke studied law at the University of Ife, now known as the Obafemi Awolowo University. I'm sure Funke would prefer that we still call it University of Ife. Before she proceeded to the Nigerian Law School. She holds an MBA from the Pan-Atlantic University. When we went there, it was known as the Pan-African University. She has over 30 years of banking and trusteeship experience, having worked in the legal department of Union Bank of Nigeria PLC as head of trust services, Union Trustees Limited. She was the director of UBN Insurance Brokers Limited, ex-officio of the Association of Corporate Trustees, and is a council member of the Association of Investment Advisors and Portfolio Managers. Mr. Roger Holman trained as an accountant before turning to tax, spending time in London and Scotland. When he returned to the Southeast, Roger spent 10 years building tax compliance and advisory business for law firms in Kent and London, and joined Mark Davies and Associates from DWF, the world's largest listed legal business, where he provided advice to UK and internationally based entrepreneurs and trustees. Roger's primary focus is on capital taxes, tax planning for UK and non-UK domiciled individuals, together with advising on all other taxes that affect individuals, including income tax and CGT. It is Roger's thorough understanding of tax compliance which allows him to use more effective tax planning techniques, as it gives him an insight into the workings of high net worth individuals and how their thought processes are developed. Before we start, we'd just like to take a poll, a quick poll, just to get the conversation going and to give our panelists some direction to this conversation. So if the team is ready, we'll be deploying the poll. The poll has 4 questions. You will immediately see the questions in just a while, and the results would also show in a few minutes after the poll has been deployed. I would ask that you interact, like I said earlier on, in the comment section. If you want to make any comments, please do so in the chat box. And if you have questions, please feel free to put those in the Q&A. We'll be looking at both boxes, but please, so that we don't lose out on any questions, please use the Q&A. So now the poll is up. And the first question is, in your opinion, is estate planning limited to writing a will? It's a yes or no question. Please go ahead and answer. The second question is, if you have not written a will, which of these reasons best explains why? Estate planning is a sad reminder of mortality, would generate unhealthy rivalry and bad blood. I do not have any assets. Okay. We would end the poll in a few seconds. We'll end the poll in a few seconds. There are 4 questions in all. Right now, we have only 10% that have voted, so please continue to vote. We will be ending it in a few seconds. I trust that we can all see the 4 questions on the screen. Panelists, by all means, you are also allowed to vote if you so wish. We're almost there, 40% voted. Okay. And I think we will end it in another minute or so. So please, if you haven't voted, please quickly do so. I will end it as soon as I have 70% voted. Now I have 62. I have 66%. Okay, almost there, almost at 70. And yes, 70. So there you are. In your opinion, is estate planning limited to writing a will? I think the audience is fairly knowledgeable one. So yes, they say no, it's not just limited to writing a will. If you have not written a will, which of these reasons best explains why? And we have 55% say that I do not have that many assets. That's the highest in terms of the voting. And 5% say I have not given any thoughts to this. Hopefully at the end of this conversation, we would have done so. In response to the third question, at what age and status do you consider it appropriate to start planning your estate? Once I acquire sufficient assets, I think that aligns with the response to the second question. And that's 58%, that's the majority of the votes. And 8%, I have not given any thought to it. The bracket of 50 and above is at 11%. And in response to the final question, what do you consider the overriding reason for estate planning? The majority of the participants at 53% have said that all the reasons adduced above, meaning well-being of underage children, to manage costs and estate taxes, gifts and donations to charitable organizations, seamless transfer of assets to loved ones. So that seems to be the preponderance of views. Okay, thank you very much. So without much ado, we're going to go straight off into the conversation. And I'm going to invite Roger in a few minutes, between 10 and 15 minutes, to share his perspectives. Roger, over to you. I know that you have some slides, so I'll enjoin participants to please pay attention, note your questions in the Q&A section, and if you just want to have a conversation, please do so in the chat box. Roger, please.
Thank you. Sorry, just trying to share my screen there now. So thanks very much for inviting me to present to this audience. We at Mark Davies and Associates are a firm of private client tax advisors in the UK, and we provide tax advice and planning services together with compliance for international clients moving to and from the UK or investing in the UK. Today, I'm going to be talking about the global perspective of estate planning, the role your investments play in that estate planning, some little bits on tax planning as far as estate planning is concerned, and then finally finishing off with how to think about creating lasting legacies. So during the last decade, estate planning has become far more transparent with a gradual erosion of privacy. FATCA was introduced by the US in 2010, closely followed by the International Common Reporting Standard, or CRS, regime. In fact, the erosion of privacy really started much earlier than the introduction of FATCA, with the anti-money laundering rules being put in place from around about 2003. This really hit the professional services firms from then, as we had to start collecting a lot more data about clients. Now it's the norm if you're going to be doing any professional services work for you to be asked for your passport before conducting any sort of financial business. Following on from the reporting regimes, the disclosure of tax avoidance scheme rules have been introduced around the world, with the EU's DAC 6 regime by far the most wide-reaching so far. If any transaction involves international tax advice within the EU, it's potentially reportable under this new regime. Many jurisdictions have now either public or governmental beneficial ownership regimes for land and company ownership. These registers not only provide details of who is the legal owner, but also who is the person behind the throne. For example, if I held shares in a UK company for the benefit of my father, both he and I would be named on the company's house. Me as the legal owner of the shares and my father as the ultimate beneficial owner. In the UK, these registers are open to the public, but as always with these sorts of things, there are ways to avoid being named on the registers if you're using the right structures. This erosion of privacy has been labelled by governments as a way to stop terrorism, but in many cases, it just causes wealthy families more and more difficulties in finding the right structure and the right jurisdiction to ensure their financial affairs can remain private. In addition to the transparency issues that have affected international estate planning, we've also got to be aware of jurisdictions that follow the forced heirship rules. Sometimes using some of the structures we talk about later can help if the rules want to be avoided. Now, before I start this section, I really need to emphasize that I'm not a regulated financial advisor, and so I'm not giving any financial advice. However, I have been advising families long enough during their estate planning to have seen many of these sorts of situations arise. Now, estate planning is really no different to other sound financial planning when it comes to investments. If a family want a decent return on their investments while keeping the risk profile reasonable, they need to ensure their portfolio is well diversified. Quite a lot of families opt for the multiple manager approach to increase their diversification. Sometimes we can find that each manager, though, is investing in broadly the same assets. So this means that actually the diversification isn't as diverse as the family originally thought. Oh, sorry, I've flicked on a few slides there. Where multiple managers are used, and sometimes it is worth using multiple managers to keep them on their toes, it's good to have someone with an overarching mandate to ensure that each manager is held to account. Services provided by the likes of ARC, the asset risk consultants, or Enhance can ensure that managers are held to account. Now, taxation is something that crops up in almost every aspect of international estate planning, which of course is good for me because that's what I do for a living. There are a variety of investment and wrappers used, and each one has its own quirks for taxation, depending on both the country that the investment and the wrappers are in and who holds the investment. Now, it's a massive topic and not something that we can really enter into here, but if anyone is keen to discuss it, I'm always happy to talk about it outside of this webinar. Now, it's not only about a portfolio of liquid shares and securities when we're looking at diversification of investments. We've also got other asset classes that we often find in international estate planning. In particular, in almost every case of international estate planning, there's a substantial amount of real estate. Quite helpfully, this brings us on to choice of jurisdiction. Real estate investments are perhaps the simplest in terms of jurisdiction. The rules tend to be that the real estate is located where the real estate is. Of course, there are many reasons for investing in real estate in a particular jurisdiction, and often it just comes down to an investment choice. You believe that that piece of land is going to increase in value. Of course, in the UK, especially over the last couple of years, have seen fluctuations in exchange rates making a massive impact on how and where families invest. With the dramatic reduction in the value of sterling over the last few years versus the dollar or euro, UK real estate has become quite a cheap option. Now, of course, cheap is quite a relative term. Obviously, when you're looking at choice of jurisdiction, you've got the investment reasons for choosing that jurisdiction, but also there's the idea of the rule of law. And that is often a key factor in choosing the right jurisdiction to invest in. Coming back to the UK, because that's where I am, it's often seen as a very safe place to keep a family's wealth due to its relatively safe political climate and the strong rule of law governing property, both real estate and other assets. The downside of the UK is obviously its tax regime, particularly for real estate, where the UK has been changing the way it taxes the asset in recent years. As alluded to, taxation is often a key decision on where to invest. Many countries apply tax to investments held in that jurisdiction. Some apply withholding taxes depending on where the structure that holds the asset is located. When choosing assets, tax plays an important role in the investment decision, as it is something that can be mitigated if the right options are used. The choice of jurisdiction is also relevant when thinking about diversification. Many international families like to hold assets in jurisdictions outside of their home or business-based jurisdiction to protect their wealth from unforeseen changes in the political climate. It's much better to hold assets around the world that have so that if a major event occurs at home, you've still got easy access to funds. Holding assets in different jurisdictions also allows you to move those assets, other than obviously real estate, because you can't tend to move real estate. Before moving jurisdictions, even for assets, it's worth getting tax advice. I'm going to say that because I'm a tax advisor. There's always going to be charges when you're looking at moving jurisdiction. Now, we've already seen when looking at the investment side of estate planning, tax is integral. And that's even more important when we're looking across jurisdictions. Different holding structures are used in different countries, and some are more suited to certain jurisdictions than others. And we've got to make sure that it's right for the whole family when we're looking at the types of structures. I mean, an example of this is in the UK and other common law jurisdictions like the US and Australia, where trusts are usually a favoured holding structure just because of their flexibility. That said, we have seen a rise in the use of foundations from civil law jurisdictions like France and Switzerland. Now, this can be difficult when you're looking at the conflict of different jurisdictions when families are moving into different parts of the world, because some places like the UK just don't recognise how a certain structure is going to be taxed. Another example of that is where France really heavily taxes trusts. So a quick overview of the different types of structures that are available. We've got trusts that are the common law vehicles where assets are given to trustees to hold on behalf of the beneficial owners, the beneficiaries. They are normally arrangements to manage the succession of family wealth. Trustee is given wide-ranging powers, but they're generally constricted by the law of the country of the trust and the trust deed itself. The trustees have a duty to act in the best interest of the beneficiaries, and this is always strongly enforced by the courts. Using a professional trustee is always advised when you're looking at multi-jurisdictional aspects, as this ensures that the assets provided are cared for and used for the benefit of the beneficiaries. Foundations are very similar in many ways to a trust, and are, as mentioned earlier, they're used in civil law jurisdictions. Unlike a trust, though, foundations can carry out commercial or non-commercial activities. So defining a foundation in the laws of a country where they don't exist can be difficult. Companies and partnerships are becoming more commonly used in international estate planning, with advisors using special classes of shares or types of partnerships, such as limited partnership, to restrict the activities and rights of partners or shareholders. And typically it will be the family members who will be the partners or the shareholders. Quite often we find ourselves as professional advisors advising on hybrid structures involving a combination of trusts, foundations, companies, and partnerships. It's quite a common situation. Looking more at the investment type products that are available, many jurisdictions use life insurance style products like investment bonds and pensions to hold and manage assets. Structured in the right way, these can act in a similar way for succession planning to trusts and companies. Now, when we're looking at international estate planning and personal taxes, the first thing is always to think about where that person is actually resident. Now, in theory, that's a very simple thing to do, but it can actually be a surprisingly difficult question to answer and may, in quite a lot of cases, result in a number of countries actually claiming for the person's residence. When this happens, it's important to go to the double tax treaties of each country so that you can determine which one has the primary taxing rights. Once we've decided where the person is resident, then we need to consider if the country has any beneficial tax regimes for foreign nationals. Countries like the UK and Portugal have very favourable regimes for international individuals, but it's very important to get tax advice before you move to the jurisdiction, especially in the UK, where the right structuring can put in place before entering can mean the difference between paying 45% tax and zero tax. In fact, the UK has some eye-wateringly high headline rates of tax. We've got 45% tax on income and 40% on death or inheritance tax. But these can be mitigated by structuring the wealth in the right way, ideally before coming into the country. We will always say it's best to get advice before moving to a country and as early as possible. But in quite a lot of cases, it's possible to restructure finances even after someone has been in the country for a while to reduce that headline rate of tax. Choice of jurisdiction for an individual will also take into account any inheritance tax, gift tax, or wealth tax regimes. In some countries, like Germany, once you're resident there, you're caught for many years, even after you leave, so it's vital that advice is received before making any international move. Wealthy families are often looking to use part of their wealth to benefit others and to create a lasting legacy well beyond their own lifetimes. Some of these are based on philanthropic giving, while others incentivize younger generations to do good with their time and skills. Charitable foundations are often set up as part of the overall estate planning to allow a pot of money to be used to generate income for charitable purposes. These foundations can then bring the younger generations into the family money and philanthropy to understand how to manage it, how to make decisions, and how to determine how best to use the money to benefit others. This is often used as a first step for those generations so that they can be brought in to help manage the overall family wealth in the future. Family trusts can also be used to encourage the younger generations to enter the workplace in a more productive or giving capacity. There's a well-known UK-based entrepreneur, Peter Jones. You may have seen him on UK's version of Dragon's Den, where he created his own family trust for his children to encourage them to enter into what he deemed worthwhile professions. the idea of that is that if a child enters into a profession like nursing, their income will be supplemented by the trust. Another example of the sort of global legacy planning is the Bill and Melinda Gates Foundation, where they created their own foundation to do good around the world and help their legacy live on well beyond their own lifetime. Now, philanthropy is not for everyone, and some families just want to ensure their business or personal legacy will live on. Trusts will often play an important role in this as well, as they can ensure shareholdings of family companies are not too widely split after passing down the 3 or 4 generations. We often find that family companies do end up having to be broken up if they're not properly managed at an early stage. Thanks for listening to me. Oh, that's good. My screen has stopped sharing now. And I think I'll pass on to Mrs. Ayapula.
Thank you very much. Thank you very much, Roger. That was quite insightful. I just took a few quick notes from your presentation, the issues around tax avoidance and terrorism, particularly around privacy, which has become or becoming of concern when deciding which jurisdiction would be appropriate. Then there's of course the need for diversification, and you've mentioned the issue of tax and tax planning. Before I go to Mr. Iqbal, I would just like to ask you a question, which would probably help through some light, at least shed some light, at least for me. What factors would determine, you've given us the options in terms of what structure would be best to use for estate planning, but what factors would help us make that decision? What would I be looking at in taking a decision as to which is the most appropriate structure?
I think very often it's a case of looking at jurisdictions where the family is based. So if you're looking at a civil law jurisdiction like France, or you've got family members moving to France, then you might want to look at simple life policies or a foundation that may be recognized in France. But again, if you've got people coming to a more common law jurisdiction like the UK or the US, then trusts can be favored. And it really depends on the family's succession plans and how they want to bring the younger generations into that family wealth. Sometimes it's just a case that they want to bring them into a small element of the wealth, and so setting up a simple company to allow them to manage that money can help with that.
Would the kind of assets, would it have any bearing on the decision that I did?
Yes, because if you're looking at a trust and a professional trustee, quite often they wouldn't want to hold a trading company within that without interposing a separate investment company holding entity, because the trustee doesn't want to take on that liability of having to run the trading company.
That was useful. So we'll quickly go to Funke with your presentation. Are you ready for us?
Yes, I am. Thank you, BC.
Thank you. Thank you very much.
So I'll just share my screen. Thank you. So today we'll be talking about securing your future or our future through estate planning, legacies, and wills. Typically, when we talk about estate planning, the first thoughts or initial thoughts are, oh, it's about disposition of assets, it's about dying, so why are you being morbid and the like? There's this taboo about talking about estate planning. But actually, estate planning goes way beyond all of this. First of all, it's about your self-preservation. What would you want to happen in the event that you're incapacitated, or when you go into your golden years? that is in old age or when you're retired. So estate planning has to do with you protecting yourself first of all. And then you're also thinking about protecting your dependents or dependents in the long run. In the long term, are they going to be able to have the kind of lifestyles they used to? Are they going to be able to enjoy the benefits that ordinarily they enjoyed while you were around or not incapacitated? And finally, you'll be thinking about entrenching the values that you've always held dear to yourselves. Now, these values differ from person to person. You know, the values you hold dear might be things like education, gender equality, and the like, you know, healthcare. You're thinking about providing for indigent females, you know, helping people in your community. You are particular about conservation of the environment, you know. So all of these values, it's not just for you to hold on to them. It's necessary to socially impact them, you know, to share them and impact others. Now, to ensure that you optimize your estate plan, the best way to go about estate planning is to start with the acquisition of your assets. Now, Roger talked about some structures that can be utilized in acquiring assets. You could use the trust vehicle, you could use a limited liability company, you could use partnerships, you could use foundations. Now, it all depends on what are your plans, your goals as regards your self-preservation, the preservation of members of your family, and the values you want to entrench. So it's important to start right from the acquisition stage. And why is this very essential? It's very essential because the tax ecosystem is presently not too friendly as concerning disposition of assets through trust. If you create a living trust, what happens is that you have to effect transfer of all the assets into the trust. Otherwise, the trust will not be properly constituted. So if you have already titled your assets in other names, then you're going to have to pay the tax man, you know, so you're going to have to incur large taxes. So it's important to determine how you acquire your assets. And then you should also think in terms of what kind of assets should I acquire? You should look at your state in life, your stage in life, your age, that is your age. How old are you now? What are the things you need to do? Are you middle-aged? Are you a young budding person? What are the things you need to do to ensure that your assets acquisition align with all of those plans that you have for yourself? And to ensure that these assets will be there for you to utilize and dispose when you eventually want to do so, it's important to preserve these assets against liability, hedge against inflation. Think about the kind of asset classes that you want to have, like Rogers mentioned, diversification of asset classes, you know, of assets. You can't particularly put all your eggs in one basket. So you have to think of how to preserve these assets. And then you finally get to the point where you are utilizing these assets, i.e., if you're still alive, you're utilizing these assets in terms of annuities and insurance policies like that for yourself, or you're using this asset, you are disposing of these assets to your loved ones, i.e., through a will or a trust. A lot of people think estate planning is something that one should do in one's golden years. No, that's not so. It's best to act now. The time to start now is now. It's never too early, it's never too late. But there are a lot of advantages that you would get from starting early enough. The first advantage you will get is that you will be able to align your goals with your asset acquisitions. And then you will also be able to title your assets the way you need to title them now, so that you won't incur huge costs of transfer in the event that you have to transfer them. And then it's also important to act now because death is inevitable for all of us. And it's better to prepare now. It's better. Prevention in this case is better than cure, because by the time you are gone, and we're talking about intestacy, it's not something very cheap. Talking about legacies, typically we would have at the back of our minds, oh, a bequest, a gift, something you're giving to somebody. Now, that's not exactly what legacies are all about. Legacies are also about the values you hold very, very dear, like I said earlier. You know, a lot of us hold on to these values and forget to pass or reinforce these values beyond our family circles. If you're going to have an enduring legacy, in the real sense of it, because a bequest or a gift can be expended, but if you impact lives, if you're going to impact lives and you're going to reinforce your values, it is better to begin to leave your legacies now. Now, live as in whilst you are alive, living it as in while you are alive. Whilst you are alive, you need to get your sphere of influence to understand that these values are very, very important to you. And you could do this in several ways. You could have campaigns calling for funds, for building wards of hospitals, sending indigent children to school, providing scholarships and the like, carrying everybody along whilst you're still very much alive and pushing these values across. And then you could also live it. If you have been living it, it's much easier to live it because, you will have a seamless transition in this instance. And then you'll be able to, having lived it, you'll be able to properly plan for the living aspect of it so that these values don't just die with you, but that they will transcend your generations and they will be able to impact the society at large. Now, there are several estate planning vehicles, but we'll be limiting ourselves in this discourse to trusts and wills. Now, what is a trust? It's an arrangement where you transfer your assets to someone called the trustee for the benefit of other persons, one or more other persons called beneficiaries. And the beneficiaries could include yourself, the settlor of the trust. Now, there are two types of trust. You could have a living trust. Now, if you have a living trust, you have to pass all of the assets while you are alive to the trust. Otherwise, your trust is not properly constituted. And then you could have a will-based trust. That is a trust that is incorporated into your will to manage your affairs, to manage your estates, to manage part of your estate for minors, to do a lot of things that you'd want to be ongoing after you're long gone. The also commonly used estate planning vehicle is wills. Now, what is a will? It's actually a legal declaration for the management or transfer of your assets that will take effect after death. Now, it's important to do a will if you know that you have assets, your lifestyle is complicated, you have assets that are huge, and you have already acquired them. You don't want to go through the unnecessary expense of having to transfer them to a trust if you so deem it. It's important to have a will so that you can pass all of these assets through a will. It's typically said that in Nigeria, there's no death tax in the sense that if you pass your assets through a will, unlike if you do it through a living trust, transfer through a living trust, you have to pay capital gains tax. But if you transfer real estate through a will, your beneficiaries are like walking away from capital gains tax because there's no such provision for it. So there's certain aspects, situations, it's important to have a will. So we can also have a combination of a trust and a will. It's a function of what you want to achieve. It's a function of where you are at in life. It's a function of the size of your estate. It's a function of what you want to achieve. So it's important to actually have somebody who's an expert talk to you, like corporate trustees, talk to you about how to go about this, so that, because a lot of people try to do a one shoe size fits all. That doesn't happen in estate planning. It's peculiar to your person and what you want to achieve. Now, we have a few differences that are listed here about living trust and wills. I've mentioned some of them, but I also talk about some others now. If you do a living trust, you're going to be having a confidential document that is not open to everyone. It will avoid the rigors of probate and probate charges, which will be much more if you die intestate. If you have a trust, it allows for the administration of your estates while you are alive. So some of the things that ordinarily would have been done when you're long gone, you have the opportunity of seeing your trustees actually carry out these duties and the extent to which they go about it and the way they go about it. And like I said earlier, once you have put the assets into the trust, it becomes constituted, it takes effect immediately. You need initial capital funds to get this going. But for a will, it's a public document. What is read, it takes effect after demise. It doesn't need capital funding, and titling is done. Titling of the deeds of transfer is done after your demise. There are certain benefits of estate planning I'd like us to consider, and the one I believe is the most important one is that it helps you to avoid family conflicts. If you have spoken to a consultant or an expert on estate planning, you'll be able to organize your affairs in a way that will make it seamless for you to transfer your assets. In certain instances, you will be advised to do it even whilst you're alive, You could do some gifting, some outright transfers while you're alive. In cases where you have complicated family lives, affairs, it's important to do this so that already you have granted or made gifts or bequests to persons whilst you're alive and you have settled those issues. Also, you would avoid meddlesome and difficult interlopers that ordinarily spring up when somebody dies intestate. I can tell you it can be very, very messy. When you plan your estate, you're accomplishing what is very, very important to you. You're planning ahead. You are ensuring that you're removing strife and rancor from your family members. You're avoiding intestacy proceedings. You are able to identify your assets. A lot of bank accounts are sitting down there that nobody knows that they exist and they're just there. So if you want your assets to be identified, if you want your beneficiaries to have complete enjoyment of what you have labored for, if you want your values to be reinforced and entrenched through your assets, the utilization of your resources and assets, it's important to do estate planning. UTL renders trust estate planning services through multiple channels. We do the offline and online. We have an triple award-winning online platform, the Willpower platform, and you can access that through www.willpower.ng. And then we have the offline services for those who have complicated lives and very, very large estates. Now, the online process and the offline process are on screen for you to look at. Thank you very much. BC, over to you.
Yes, thank you. Thank you very much, Funke. That was quite useful and straight to the point. As you would imagine, I have a couple of questions for you. The first one, came from the poll, that we took. You will notice that about 60% of the respondents to the question as to why they haven't thought to write a will, 60% of them, well, almost 60% said that they don't have enough assets. How valid a reason is that? What would you advise? What are your thoughts in that regard? When is it appropriate to start thinking to write a will?
It's appropriate to start thinking of writing a will, once you are in employment. The Pension Reform Act stipulates that employers should have contributory pension arrangements for their employees. So the employers contribute and the employees contribute. Now, a lot of people don't know that in addition to their retirement savings accounts, there's a comprehensive life policy that has been done on their behalf by their employers. And the law stipulates that this should be minimum of 3 times total emoluments. Now, if your total emoluments, for instance, is 5 million naira per annum, now that means that a minimum of 15 million will be added to whatever balance you have in your RSA if you die in the course of service. Now, a lot of people are not aware of this and they think, oh, I'm a low cadre employee, I don't have much assets. As soon as you start working, it's important to consider estate planning. That way, you'll be able to arrange your financial goals in a way that will align with providing for yourself in future and your family members. So it's not something about having lots and lots of money. A lot of people also think that they cannot entrench their values or reinforce them until they have a lot of money. No, it doesn't work that way. You can start with sponsoring 2 or 3 students. You can start with very little things, transforming a nursing station in a public hospital or the like. So you don't have to do something very huge or have a lot of money to start estate planning. It's something that we need to correct. You don't need a lot of money to start estate planning.
Absolutely, thank you. And I think another misconception is that people, don't recognize the fact that that RSA account that you mentioned is actually an asset. So perhaps a lot of people think that until I actually put up a structure, that's when I begin to think in terms of an asset. Maybe that's another reason, perhaps. So there's another question, and you just alluded to it, and that's the values. So you had said, I can start by leaving my values, and then I can leave it, meaning that I can leave it to my estate, to my beneficiaries, to my family members. What if they're not aligned? What if, during my lifetime, I did all the philanthropy that I could and all of that, but I didn't set up a foundation. How do I ensure that I actually do leave it, like you said, particularly, like I said, if family members, don't share the same values. After all, those were my values and they're not necessarily theirs. How do I ensure that I do leave the values?
Thank you, BC. The way to leave the values is to ensure that you have a structured arrangement. you can have a structured arrangement through a trust, and that's one of the best ways of doing it. So that way the trustees have the responsibility of ensuring that what you have put in place continues. There are certain instances where families have donated wards to hospitals, and then the person who did the donation passed on, and then nothing happens thereafter. You know, it now goes back to government to now take on the responsibility of maintenance and the like. Now that's where estate planning comes in. If you have put this in a trust, the trustees have a duty to ensure that for as long as there's provision or enough resources to carry out maintenance and continue to uphold those values, they do so. So it's a function of structuring, it's a function of governance. What arrangements have you done in terms of governance to ensure that this continues? So structuring, that's important. Thank you.
Thank you. And the final question I have for you before we throw it open to the participants is that what's the place of religion? You know, so there are people who will say to you that, you know, I'd rather just allow my custom and tradition and my religion. And besides, writing a will is not entirely in a line or in sync with my religion. What are your views in that regard?
Thank you, BC. We're talking about faith. For the Muslims, if somebody is a practicing Muslim, and if he writes his will contrary to the dictates of Islam, it's the dictates of Islam that would subsist, that would be utilized.
But he can write a will.
He can write a will, but he has to remember that it's only a certain percentage that he can do whatever he likes with, because there are laid down procedures. So if somebody is a Muslim, it's his religion that would indicate the way that the assets are shared. Now, if somebody has been practicing customary laws, for instance, if the person got married through customary law, the different customary laws of the person, the personal customary law of that person would apply. In certain instances, the personal customary law of the place where the person is residing is what would be applied. So these things also come into play actually. If somebody is a Muslim, there's an extent to which he can dispose of his assets. And if somebody has practiced customary law all his life and got married in through customary law, certainly the dictates of customary law would apply.
Thank you. Thank you.
But if somebody is married under the Acts, then the Wills Act and administration of estates laws will apply.
And you can dispose of it by the will. Thank you very much. Okay, I still have a few questions, but I'll come back to those later. So at this point, you know, like I mentioned at the beginning, I will just be showing you a very small clip to describe to you what willpower is about. So if you're ready back end, please let's see willpower. Thank you very much. The volume wasn't, well, at least I didn't hear it. I don't know whether anybody else heard, but I guess, yes, we'll go to, Funke has already given us the website and we'll share it again later. So we have the questions here already, and I will start with the first one. There are quite a few questions, as would typically be the case. The first one, please shed more light on international pensions as a type of estate planning structure. Roger, please, if you would like to answer that question for us, since it's talking about some multi-jurisdictional thing here. Please shed more light on international pensions as a type of estate planning structure?
Yeah, thanks, BC, and thanks for the question. I've put a note in the Q&A there answering, but essentially it's very difficult to kind of go into too much detail on international pension structuring because each case is very specific to the circumstances of the individual. And it's also specific to the jurisdictions that we're looking at. But as a general kind of overview, when we're looking at international pensions, they're used in estate planning partly because it allows the people to protect a pot of money that can be used for their own pension or can be used to pass assets down to the future generations. And typically pensions are very favored from a tax perspective in most jurisdictions. But as I say, you've got to be careful that in whatever jurisdiction you're looking at, the specific pension fits into the rules of that jurisdiction.
Absolutely. Thank you. Thank you very much. I think this is a follow-up question, although it relates to Nigeria, but since we're talking about tax planning, I'll just leave you to, I'd like you to answer it as well. You referred to it in your presentation. To what extent can estate planning be used to manage taxation?
Well, again, it's quite often, it will be jurisdiction dependent. So trusts and other structures that we use in estate planning can be used to reduce either an income tax exposure. So using a corporate vehicle can often have a lower tax rate than an individual person's tax rate. And trusts are often used when we're looking at inheritance planning and trying to secure the succession, whilst also looking at the tax advantages that you can get from that. Again, it's going to be jurisdiction dependent.
Okay, that's fine. Funke, do you want to give the Nigerian perspective to that? You're muted. You're muted. You're muted. Estate planning, looking at it from the, you're muted. You're mute. Okay. Yes, estate planning, looking at it from the tax perspective, what advantages would we get from a tax perspective?
Estate planning, looking for me from getting benefits from the tax end, is that if you plan your estate, you'll be able to avoid some costs. For instance, if you don't plan your estate and you die in intestate, you'll be paying 10% of all of the value of all your assets if letters of administration are being obtained.
10%.
Now, if you plan, yes. Now, but if you plan your estate and you have put your assets in a will, you'll be paying only that on the real estate aspect of it. The valuation will be done on the real estate aspects of it. So that's what you'll be paying. You know, that's a tax bit of it that you will be paying. So you'll be able to manage, what I mean is you'll be able to manage your tax if you plan properly. But if you don't plan, there's also the bit about just acquiring all kinds of assets that will be eroded by the tax payments that you have to make because you did not make plans for your estate. So it's better to plan so that you can determine the kind of assets you're acquiring, how to ensure that tax does not erode it. That's very key for you.
Okay, thank you. This question is for you, Funke. What kind of assets could be covered by living trust? You mentioned bank accounts during your presentation. What other assets could be covered?
Okay, I was actually even responding to that question on the Q&A when, you know, so okay. You can put all kinds of assets into your trust, but you must consider the huge cost of transferring real estate into a trust. So that's why I said it's better to have titled your assets if you're buying real estate, to have titled them in the name of your trust if you intend to utilize a trust along the line. So it's important to think of that, or to think of utilizing a company, limited liability company, so that what you're transferring is actually the ownership of the company. So you have to think about that when you're doing, when you're transferring your estate.
Roger, I would like to ask you this question.
I haven't concluded, sorry.
Oh, I'm so
so
sorry.
Other assets that you also can put into your trust, you can put your shares, you can put for shares as well, you also have to go through the transfer route. And like I said, the tax ecosystem is yet not that friendly for you to be able to do that without incurring huge costs. So you still have to pay to transfer it into it. And then also designated assets that have designated beneficiaries, like insurance policies. It's no use putting them in the trust because you have beneficiaries that have been so designated. And then bank accounts that you have also designated payable to a particular beneficiary on death, at death. You don't need to put them into trust because you have already indicated who would be getting that asset.
Thank you, thank you, thank you very much. Roger, I was going to ask you a question about foundations. If I want to set up a foundation, what should I have at the back of my mind in terms of taxation? What will be the tax implications of setting up a foundation?
Well, one of the big things, and I keep saying jurisdiction in my answers, is the jurisdictions that you're looking at.
Let's look at the UK.
So in the UK, we don't tend to find very many foundations being used where they have any kind of economic value. The reason for that is because we don't actually have a foundation law in the UK. We have very strong trust laws, but no law governing foundations. So what we have to do as tax advisors in the UK when we do come across foundations being used, and quite often they'll be Swiss or Liechtenstein foundations, is we've then got to try and work out how that fits into our tax system. And it's either going to be taxed as a company and face corporate style taxation, or it's going to be taxed as a trust. And it's very much dependent on how the foundation is drawn up and how it's actually being used during the term of its existence.
Okay, thank you very much. This question goes to you, Funke. The person is close to retirement and they want to know, and they're in the public service, almost 60 years old. They want to know which asset acquisitions do you advise that I can venture into?
Thank you.
I guess from a perspective of estate planning.
First of all, you have to think of yourself, like I said, you're already in your golden years. So you have to think of yourself. Now, it's going to be a bit expensive for you, especially if you're going to be going into annuities at this time. It will be expensive, but annuities are one of the things you need to consider so that you can have payouts over a period of time, for as long as your annuity plan makes it possible to do so. Also, this is not the time to begin to do volatile investments, investments that have very high risk. You don't have the appetite for this now. So it's best for you to be considering things that are investments that will not raise your blood pressure. You'll be thinking about real estate. If you have enough money for real estate, you'll be looking at things like that. You'll be looking at things that will not put too much pressure on you. And like I said, first of all, self-preservation, and thereafter, what you can leave for your beneficiaries. Real estate, if you acquire a commercial one, will help you to earn some rent, meet your obligations presently, and also will be available for passing on to your beneficiaries. And one of the advantages of real estate at any point in time is that real estate is one asset in Nigeria that keeps increasing in value, hardly ever depreciates. And the place that is considered a local or inland or somewhere in the corner today, in the next few years, you won't believe the value of that asset. So real estate, annuities are the things that I would advise at this point for you to do.
Awesome.
Thank you.
Thank you very much. Roger, this question is for you. What will be the effects of Brexit and taxation on assets and investments located in other parts of Europe held by UK trust or vehicle?
I wish I had a crystal ball to answer that.
I could let you use mine.
It's a very difficult question because, as you probably know, our government isn't doing the best job of handling the whole Brexit process, and how we are going to look at taxation across Europe is going to be dependent on how we come out of both the Brexit situation and the COVID situation at the moment. My personal opinion is that we will see taxes on hold in the UK for some time, because we need the UK's economy to recover. And that may mean, because we have a Conservative government with such a big majority, that we will see lower taxes for foreign nationals to encourage investment into the UK. It's a possibility. It's very difficult to see into the mind of the Chancellor, because he's been doing some very strange things over the last few months.
Absolutely. So I guess we wait and see.
Yeah, sadly, it is a case of waiting and see.
Okay, thank you. What legal provisions, Funke, this will be for you. What legal provisions are in place in Nigeria to ensure that trustees act in line with the established trust and not as they deem fit? To what extent can a trustee use his personal judgment in the administration of an estate?
Thank you. Laws relating to administration of estates have to do with administrative laws of the different states in Nigeria. And then you have to also remember that there are two sets of trustees, individual trustees and corporate trustees. For corporate trustees, the Securities and Exchange Commission has an oversight role on corporate trustees to ensure that they carry out the duties in line with the requirements of the law, i.e. in good faith, and ensure that they do things properly. Now, if someone has utilized a trust vehicle in planning the estate, now the trust vehicle typically vests a lot of powers in the trustees to carry out the duties, to transfer or manage the assets of the trust as dictated by the trust. Now, in certain circumstances where the trustees have to determine or use their discretion, for instance, now, if somebody constitutes a trust today and says, give my daughter 500,000 naira every month for upkeep in the UK, equivalent of 500,000 naira. Now, if this person constituted the trust as at the time when naira was 160 to the dollar, now it's going to be a different ball game from when it's 450 to a dollar. So the trustee in that instance is expected to use the discretion to do what is required. Now, but the trustee cannot just determine that they want to do anything they want to do. In administrative estates in Nigeria, there's a requirement that every 12 months you have to make a report to the courts. So you have the oversight of the courts as well, watching to see what you're doing in the execution of the trust, the execution of the assets that you are managing as an executor. So it's important to have this at the back of our minds, that the SEC is watching the corporate trustees, the administration of estates laws, it's on the civil procedure, high court civil procedure rules of the various high courts of the different states. They have rules and things that they expect the executors to adhere to, and the rules of the laws of the administrative laws of the different states. So it's important to realize that yes, trustees and executors have the power of discretion, but there's an extent to which that can go. They don't have a totally unfettered power of discretion to do just whatever they like.
Let me ask a right-on question on the discretion. Okay. So let us say that the scenario that you have painted, that I have given instructions that XYZ amount should be given to my daughter in the UK every month. And then it turns out that this daughter is what you would call a spendthrift, and just not doing well and just waiting until the next check comes and really not just doing, has no other means of livelihood and is just spending the money, as it were. As a trustee, what would be my role? Am I able to now use my discretion to withhold the funds, or what would be my role as a trustee?
Thank you, BC. Typically, what we advise is that spendthrift clauses or provisions be included in trust documentation. And even in instances when they are not in trust documentation, what we do is that we will do what a reasonable person would do in the circumstance. Now, let me paint a scenario for you. We have certain instances where courts have appointed UTL to act as executors or administrators of estates that are in contention. Now, there are certain instances where you have to see to the upkeep of some beneficiary or dependents. Now, you have to use your discretion in determining what they get in certain instances because all kinds of requests will come your way. Now, the question you need to ask yourself is, what would a reasonable person do in the circumstance? How would you behave in that circumstance? For instance, you're definitely not going to buy an LV pair of shoes for a 14-year-old, would you? Neither would you be thinking of buying an iPhone, the latest iPhone for a 7-year-old. So you'll be thinking about what would a reasonable person do in the circumstance. Now, you might say, oh, it's relative. Yes, it is relative. But if you pay for LV pair of shoes or a jacket for a 14-year-old or a 12-year-old, when you're making your reports to the courts, how are you going to explain that you did what a reasonable person did? Would do? You understand? So these are the things that we need to take into consideration because you need to realize that for as long as you're administering this estate, you're supposed to be looking at it from the perspective of what is reasonable in the circumstance of the person that we're talking about. You understand? In terms of age, in terms of
again subjective, but I guess we have to leave some element of subjectivity.
Yes, you have to. You have to.
Okay. Roger, this question is for you. What is your opinion on investing in the money market, for example, stocks, in the current COVID era and post-COVID? Is it advisable to invest part of your precious retirement benefits in any of these vehicles? If not, what would you suggest and what's the way forward?
Well, I find this a very difficult question because I'm a tax advisor. I'm not an investment advisor. So from a tax perspective, investing anything through retirement benefits is tax neutral in most countries. But from an actual investment perspective, I think I have to say that you'd need to speak to an investment manager to get an answer to that question.
Thank you. Thank you very much. This is something that I think would be up your lane. If I'm not ready to start planning for my estate right now, I'm not ready to start estate management or to take out a trust, could I use a company to buy my house, meaning that I register a company and I transfer that asset to the company? Would that be a tax effective move on my part? Roger?
In the UK, definitely not, because we have stamp duty taxes that will massively impact you. You'll end up paying a lot of stamp duty tax. And then if you're living in the property as well, you will end up paying an annual tax on the corporate ownership. That said, if the property is bought by a company to be rented to a third party, quite often we find people using a company for that purpose because the tax rate in a company is significantly lower than the personal tax rate.
Okay, thank you. Okay, you wanted to say something?
Yes.
Did you want to add something?
If you buy the property in the name of the company, you will get tax benefits in the sense that to transfer ownership of that house, all you need to do is transfer the interest of the company.
Okay.
Do you understand? It still belongs to the company.
Absolutely.
So you just be transferring the shareholding.
The shareholding, absolutely. Okay. Just wanted to quickly see this other question. I know that I saw a question for you from K just now. Whilst I'm looking for that question, Funke, can I just ask you this? if I write a will, or let's say if I have done, I've taken out a trust, and I prefer not to write a will, can I do one, instead of the other? Do I have to do both?
Thank you, BC. Like I said earlier, it depends on what you want to achieve, but it's usually best to have a trust and a will if you know that, because there's some assets that you acquire afterwards. And like I said, if you don't effectively transfer the assets to the trust, there's nothing that the trust can do. The trust would not have any right to be able to effect any transfer thereafter. So it's typically good for after acquired assets, to have a pour-over will that will take care of after acquired assets that you have not put into the trust. And especially sorry?
Go ahead.
Especially if you don't want to transfer, if you're looking at the huge cost of transferring assets into the trust, it's typically very good to have a will that will take care of real estate and the like.
Okay, I was going to say that, can I then, just make a conscious effort as soon as I have acquired whatever asset, I just make a conscious effort of sweeping everything into the trust?
Yes, you can sweep it into the trust, but like I said, you need to be mindful. One of the reasons why you do estate planning is to minimize your costs. So you have to be mindful of the transfer costs. It's pertinent. Absolutely. That you're mindful of the transfer costs.
Okay.
You can always sweep it into it as long as you're ready to pay the attendant cost that will go with it.
Okay. After setting up a living trust, to what extent can the settlor be involved in the management of the investment and assets under the trust without invalidating the trust constitution?
Well, if you have set up an irrevocable trust, you don't have any business with that trust. But typically, most of the trusts that are set up are revocable trusts. And in revocable trusts, the settlor a lot of times still has discretion, to say, oh, okay, these are the classes of assets I would want you to invest in, and these are the things I would like you to do. And typically the settlor can from time to time say, okay, I want to vary the terms of the trust. This is how I want you to go about it. So it's a function of the kind of trust you have.
Okay. Again, this is for you, Funke. I would like to know what happens if, for whatever reason, the trustee is liquidated or goes bankrupt. If such does happen to trustees, please, what happens to the assets managed by the trustee?
Thank you. Like I said earlier, the SEC has oversight of corporate trustee functions. So if you utilize a corporate trustee, if that corporate trustee is going out of business, the assets being managed by that corporate trustees will be passed on to another trustee. The SEC will not sit back and allow you to go away with the assets of clients. That's why the SEC prescribes total distinction, separation of assets between the assets of the trustee and the assets of the clients. And on a periodic basis, we render quarterly returns. They do periodic inspections to ensure that this is adhered to. So typically, given the monitoring that's being done, if the trustee is beginning to have issues, the SEC will step in and ensure that the assets are not eroded, because typically they're separated. The penalties for commingling, as it were. So it's good to use a corporate trustee. We're being governed properly. The oversight function of the SEC is very, very functional. And so the situation where the trustee will be liquidated and will go off with the assets of the company, of the client, is very slim. Now, also, there's something that we need to realize. If you know that you have a very large estate, what some settlers or testators actually do is that they make provision that in the event that a trustee is going to be liquidated or would go bankrupt, the trustee should pass the assets on to another corporate trustee. Now, there's been an instance of a client who had a testamentary trust, that is a will-based trust, and appointed 3 separate trustees. In the first instance, the client appointed trustee number 1 to say, hold on to my assets, be my executors. In the event of liquidation or bankruptcy, please move my assets to trustee number 2. And then that same client went ahead to say, in the event of liquidation or bankruptcy of the second trustee, please move my assets to trustee number 3. So that's another option to hedge against liquidation or bankruptcy.
Roger, I would like you to give the UK perspective. You know, you had said foundations are not regulated. I imagine that trustees are. To what extent would, if a scenario like has been painted, you know, how would that be treated if it had happened in the UK?
It's very similar to what Funke was saying, in that if a trustee did go bankrupt in the UK, the assets of the trustee are very separate to the assets of the trust. So the trustee is acting as the legal owner of those assets, but not the beneficial owner. And we're very strong in the UK about that separation of legal and beneficial ownership. So it means that if the trustee did go bankrupt, a new trustee would then be appointed under normal rules determining who will appoint a new trustee. Typically that will be within the trust deed. Sometimes it won't be, because we'll have trust deeds that are 60, 80 years old. And so we'll have to go through the court process to appoint a new trustee. But usually there is a way to appoint a new trustee without any difficulty.
Okay, but now, if I hear you correctly, there is a requirement to actually include the appointment of a new trustee in the trust deed now.
Yes, we would always see that within the trust deed, and we'll have, typically the settlor would have the right to appoint a new trustee. There are also ways in which the beneficiaries can appoint new trustees. If they all act together, they can appoint a new trustee through the court.
Thank you, thank you. We just have time to take a few more questions, maybe 2 questions. This is for you, Funke. What is the process of obtaining the RSA funds in the event that a person dies in service? Does the payment of 3 times the contribution apply in both the public and private sectors? It's a triple layered question. What is the source of the payment of the triple sum in the RSA? Is it the PFA, the government, or the employer? I imagine that that's insurance. Funke.
Okay, thank you. The provision of the Pension Reform Act is that to assess the benefits of the RSA, you must produce letters of administration or a will. So it's important to have a will, or letters of administration will have to be procured. The initial law made provision for trust, but subsequently the trust aspect was removed. So it's just the will or letters of administration as it were today. Now that's what the law says. Now, as concerning the 3 times total emoluments, it's a function of the insurance cover, the group life insurance cover. So all that your employer does is to pay the annual premium, and the annual premium will come from your employer, whilst the 3 times total emoluments will come from the insurance company. So the way to go about it is that once the person, the PFA, is notified that the employee is dead, the next thing to do is that letters of administration or wills will have to be provided and tendered to the administrator before access can be granted to the funds. So it is after that is done that there can be access. But in the interim, the proceeds of the insurance company can be collected if you have used a corporate trustee. We can collect on your behalf whilst we're still waiting for the letters of administration in the event that the person died intestate, or whilst probate is still being obtained.
Okay.
And this is just to alleviate the sufferings of family members.
Family members, absolutely. So, but if there's no trust, then we have to wait until we obtain probate.
Well, if an individual or personal representatives or administrators have to collect it, they have to tender the will. They have to tender the letters of administrators to the PFA, and then they also, or the wills to the PFA. And that is after the will has been, probate has been granted to the will.
I think we just take this final question. How can organizations help their employees in ensuring they have an estate plan in place, because most of the time the burden is on the employers.
For me or for Rogers?
For you, Funke.
Okay.
I mean, if Rogers wants to chip in, you can.
Okay. One of the ways that employers can assist the employees as regards estate planning is to ensure that in the same way that you make arrangements for them to be registered with pension fund administrators, you also ensure that it is part of the requirements of your institution that wills are done, particularly RSA wills, that is retirement savings account wills. So that even if the employee says, I don't have any other asset or I don't have other tangible assets, this will be covered. Debt in service benefits from the employer will be covered. The comprehensive insurance would also be covered. So that way you've made it easy for the beneficiaries of that employee to assess the benefits. So we encourage employers to make it a requirement, to make it mandatory in the same way that pension fund administration registrations are done, that also RSA wills are also done. And on our platform, Willpower, you can do your RSA wills seamlessly from the comfort of your home or your offices. Thank you.
Thank you. Thank you. I know I did say that was the final question, but I would like to just ask this one. And I would like Roger to please answer. I know it's a trust or will related question, but since you're in that business as well, can beneficiaries of a trust or will agree to take certain decisions against the wish of the settlor or the testator?
In the UK, the beneficiaries of, well, particularly of a trust, are able to, if they all act together, they can actually ensure the trust is fully distributed among all the beneficiaries in one go. This follows UK case law. Similarly, if the beneficiary of a will wanted to actually pass their entitlement of that will to their children, if they do that in a specific way, it can be treated as if that entitlement has been passed under the will of the deceased person, which often has quite significant tax benefits for the estate and for the beneficiaries.
Thank you. Funke, any perspective?
Well, I think that if you're talking about the beneficiary saying that they want to amend, if somebody has constituted a trust and given instructions about how it should go, typically the trustee is expected to adhere in line with the trust deed, because there's a documentation, there's a deed that says this is how things are supposed to be done, this is how distributions are supposed to be effected. We're expected to adhere to them, because otherwise, why the person go to the extent of being intentional about planning the estate? You know, if beneficiaries are just going to wake up one day and say that they are going to be doing things their way. However, like I said earlier, if it is a situation where maybe because of passage of time and certain situations, if it has to be do with money, you know, or shares or stuff like that, and it's in the best interest to do it in a way that will be beneficial to all of the beneficiaries, you know, i.e. to alter maybe some terms of the trust, yes. But ordinarily, it's apart from protectors of the trust who can from time to time amend the trust, it's usually the practice to adhere to the terms of the trust.
Thank you. I would imagine so. Thank you very much. And as with every good thing, we have come to almost to the end of this webinar. We have so many questions that we're unable to take. That's usually what happens. But I can assure you, for those who have asked the questions that we haven't been able to answer, that we will do so in sending you the summaries of this conversation this evening. But before we start to wrap up, I would just like Roger to say a few words as we end, you know, to sort of wrap up your thoughts on this subject matter. Roger, please.
Thanks. Well, yeah, I mean, I suppose the prime takeaway from my perspective is to ensure that whenever we're looking at any kind of estate planning, be that local or international, you go and you make sure you get the relevant professional advice. It really is the most vital thing, whether that is simply writing a will or whether it's putting into place an international estate plan covering multiple generations. The professional advice is the most vital thing that you can get.
Thank you. Thank you very much, Roger. Funke?
Thank you, BC. In addition to what Roger has said, I would say please be intentional about estate planning. If you are not intentional about it, you would have just labored to a large extent for nothing. I'd like people to remember the case, the UKJ versus UKJ case, where someone had to wait for over 30 years to get access to an inheritance. It's no use getting access to your inheritance 30 years or more after you should have gotten it. So please be intentional. Do your estate planning today for your self-preservation, for the preservation of members of your family, and for the entrenchment of your values. Thank you.
Thank you. Thank you very much. Before we finally sign off, since I have the privilege of being the moderator and you have the privilege of listening to me, I would just quickly like to share a few of our upcoming training events at DCSL. The first one is happening on the 27th and 28th of July. Is a training for company secretaries. We also have a corporate governance masterclass scheduled for the 14th of July, that's next week. And then we have an audit committee masterclass on the 16th of July 2020, also next week. And we have an HR masterclass coming up also later in the month. You're going to get details of all our forthcoming trainings. Follow us on our social media handles as displayed on the screen. And I would also just like to wrap up by saying to re-echo what our panelists have said, seek professional advice in planning your estate. At the end of the day, that's the only way to go, because obviously you don't have the requisite professional insights yourself, whether you want to write a will, whether you want to set up a trust. And of course, please be intentional. It's important for you to articulate your wishes and your desires. And again, like Funke had reminded us, estate planning is not just about sorting out your assets, but also your values, leaving the legacy that encompasses not just your physical assets, but your moral assets. What do you believe in? What do you want to leave on to your beneficiaries and those that you want to pass on those values to? So thank you very much, Funke. It's been wonderful having you. Thank you for your insights. Thank you very much, Roger. It's been wonderful having you. Thank you for giving us another perspective to tax planning as it relates to managing our estate. And to our esteemed participants, I thank you very much for being interactive. Unfortunately, like I said, we couldn't take all the questions, but we'll try as much as we can. Our panelists will help us to answer those questions that we haven't been able to take during this live session, and we'll send them to you. So until our next event, I say have a very good evening. Thank you very much.
Thank you.
Thank you.
Bye.
Thank you.
Then, you grow old and die. Your fortunes go to your brother in the village. Imagine you get the job of your dreams. Marry the love of your life. Acquire priceless assets. Have a beautiful family. Then, you grow old and die. Your fortunes go to your brother in the village. Your wife and kids are evicted from your home. Your company is taken over by your business partner. This is not a Nollywood movie. It has happened before. But the question is, will you let it happen to you too? Avoid Ujiwa Kiingi stories. Set up a will on willpower.ng today and secure the future of your loved ones. Willpower. Write a will, empower your future.
Yes, please.